The biggest investors on Wall Street are quietly shifting billions into AI ETFs, while most retail investors like you and I are still stuck in traditional tech funds. AI is changing everything, from finance to healthcare to automation. But here's the real question. Are AI ETFs actually outperforming traditional tech ETFs? Or is this just another overhyped bubble? If you're feeling FOMO about AI or wondering how much of your portfolio should be in AI ETFs, you're not alone. The fear of missing out is real. The fear of making the wrong bet is even worse. And let's be honest, no one wants to be the person who's ignored AI and got left behind. So in this video, we're breaking it all down. Which AI ETFs are actually winning, how much you should allocate based on proven strategy, and most importantly, how to follow smart money moves without taking on unnecessary risk. This isn't just theory. We're looking at real numbers, real case studies, and real strategies to make AI ETFs work for you. Now be sure to subscribe with notifications on if you get value, and smash that like, it helps this channel. Now let's get into it. Traditional tech ETFs versus AI-focused ETFs. We already know that AI is dominating headlines, but here's the real question. Do AI-focused ETFs actually perform better than traditional ETFs? Or is this just another hype cycle? Well, let's look at the numbers, okay? Over the past 5 years, some of the biggest AI ETFs like Global XAI and Technology ETF, which is AIQ, and Robo Global Robotics and AI ETF, or let's just call it Robo, R-O-B-O, have posted returns that in some cases outpace traditional tech ETFs like Invesco's QQQ and Vanguard Information ETF, the VGT. For example, while QQQ, home to giants like Apple, Microsoft, Nvidia, have delivered solid returns, AI ETFs have shown periods of explosive growth thanks to the rapid adoption of AI-driven technologies. But here's the catch. AI ETFs tend to be more volatile than broad tech ETFs. Traditional tech ETFs benefit from stability. Companies like Apple and Microsoft, they've been market leaders for decades. AI ETFs, on the other hand, are packed with companies that are either in hyper growth mode or still unproven. And that means higher upside potential, but also sharper drawdown. So what's the bottom line? Well, if you're looking for steady long-term growth, traditional tech ETFs are still strong contenders. But if you believe in AI's long-term dominance and can handle much more volatility, AI ETFs could be an opportunity to get ahead of the curve. Now, the big question is how much should you allocate to AI ETFs without overexposing yourself to risk? That's where the 40-30-20-10 strategy comes in. And let's break it down. How to allocate AI ETFs in your portfolio. 40-30-20-10 rule. So you're convinced AI is the future, but the real question is, how much of your portfolio should go into an AI ETF without taking on too much risk? This is where the 40-30-20-10 strategy comes in, a structured approach to balancing market cap, innovation potential, and risk exposure. 40% in large cap AI leaders. These are the giants driving AI adoption, like Microsoft, Nvidia, and Alphabet. They provide stability because they're already cash flow positive and deeply integrated into AI development. 30% in mid-cap innovators. Think companies like Palantir or UiPath. They have strong growth potential, but aren't as dominant as the large cap players, okay? Then we have 20% in emerging AI disruptors. This is where the high risk, high reward plays come in. These are smaller, faster moving AI companies that could be the next big thing, but also the most volatile. And then we have 10% in speculative micro cap AI funds. If you want to bet on the absolute cutting edge, this is where you put a small calculated allocation. These are the AI startups and niche AI firms that could explode in value or fade into obscurity. This framework ensures diversification while still letting you capitalize on AI's upside. It also prevents overexposure to highly speculative plays that could wreck your portfolio in future in a downturn. But picking the right ETFs is only half the battle. The real edge comes from knowing where institutional investors are putting their money. See, because when the big players make moves, they leave behind a trail. So let's analyze that next. Tracking institutional money flow into AI ETFs. If there's one thing that separates smart investors from all the rest, it's this: follow the money. Follow the money. See, retail investors often chase hype, but institutional investors, hedge funds, pension funds, asset managers move billions based on deep market research and insider level data. And when they start piling into specific AI ETFs, it's usually for a reason. So there's smart money flowing. Where is it flowing though? Well, recent 13F filings, which reveal what major institutions are buying, show increased positions in ETFs like ARC-Q, the ARC Autonomous Technology and Robotics ETF, and BOTZ, BOTZ, Global X Robotics and AI ETF. These ETFs focus on AI-driven automation, a sector that's seeing massive enterprise adoption. Another key signal: trading volume spikes and unusual options activity. When institutional money flows in, it often leads to a surge in volume and large option contracts, moves that retail traders typically can't match. So why does this matter? Because when institutions accumulate shares quietly, prices tend to move before the news hits mainstream media. See, if you can spot these trends early, you can position yourself ahead of the curve rather than chasing after the fact. But even with institutional backing, AI ETFs remain volatile. That's why it's critical to have a risk mitigation framework in place so you can protect your portfolio while still capitalizing on growth. Let's break that down next. Risk mitigation for AI ETFs. Stop losses and position sizing AI ETFs come with massive upside potential. But let's be real, they're also some of the most volatile investments in the market. If you don't have a strategy to protect your portfolio, one single downturn could wipe out months of gains. So here's how to manage risk effectively while staying positioned for AI's long-term growth. Number one, position sizing. The key to surviving volatility instead of going all in on AI ETFs is use tiered position sizing based on risk level. Large AI leaders, bigger position sizes, lower risk. Mid-cap innovators, moderate position sizes, higher potential. And then emerging AI disruptors, small positions, high risk, high reward. Micro-cap speculative AI, tiny positions, pure moonshot plays. This ensures no single position will destroy your portfolio if AI stocks hit a rough patch, okay? 2, stop losses. Protecting gains without getting stopped out prematurely. AI ETFs swing hard. Setting up stop losses too tight means getting stopped out too early. But no stop loss at all means risking catastrophic losses. So a solid approach. Use trailing stop losses, 15 to 25% to lock in gains without cutting winners too soon. Consider volatility adjusted stop losses. AI ETFs tend to move more, so set wider stops compared to traditional tech. Number 3, hedging with non-AI assets. If AI ETFs take up a large portion of your portfolio, balance them with defense sectors, consumer staples, healthcare, dividend ETFs for cash flow, inverse ETFs or put options as hedges against sharp AI downturns. By combining these risk management tactics, you can stay invested in AI's massive upside without exposing yourself to unnecessary risk. But theory is one thing. Real-world case studies. AI companies inside top ETFs. Theory's great, but let's ground this in real-world performance. Smash that like if you're all about real-world performance. Well, number 1, NVIDIA, the AI powerhouse, found in almost every AI-focused ETF. NVIDIA isn't just a semiconductor company. It's the backbone of AI innovation. Over the past 5 years, its revenue has skyrocketed due to explosive demand for AI chips, powering everything from ChatGPT to autonomous driving. 5-year revenue growth, over 250%. AI market penetration, dominant supplier of AI GPUs, over 80% market share. ETF presence, QQQ, ARC-Q, BOTZ, VGT. It's in them all. Now, number 2, Palantir, PLTR, AI for big data. A mid-cap innovator, Palantir specializes in AI-driven data, analytics for governments and enterprises. While it struggled post-IPO, its recent profitability breakthrough and growing contracts with major institutions have turned it into an AI growth story. 5-year revenue growth, over 130%. AI market penetration, expanding into commercial AI adoption. ETF presence, it's in ARKK, AIQ, QQQJ. Number 3, UiPath, PATH ticker. Automation and AI robotics, a leader in robotic process automation, or RPA. UiPath is defining how business integrate AI into workflows. Despite early struggles, its enterprise adoption rates are soaring, making it a great high-risk, high-reward AI play. Now, the 5-year revenue growth, up over 200%. And the AI market penetration, AI-powered automation in Fortune 500 companies. ETF presence, it's in ROBO, AIQ, ARKK. Number 4, SoundHound AI, or SOUN is the ticker. The AI moonshot, a micro-cap AI stock. SoundHound focuses on AI-powered voice recognition. It's seen rapid revenue growth, but remains extremely speculative. If voice AI takes off, which I think it will, early investors could see outsized returns, but it's still an unproven bet. Its 5-year revenue growth, up over 180%. ETF presence, AIQ, ARKQ. What does this mean for investors? Well, these case studies reveal a pattern. AI ETFs with a balanced mix of dominant leaders, mid-tier innovators, and speculative disruptors tend to outperform ETFs oversold with just hype stocks. And this brings us to the final takeaway. How do we put all these insights together into a sustainable long-term strategy? Well, here's the step-by-step playbook. Smash that like, y'all. This is some value, and hit subscribe. I know I'm adding value to some of you. Turn it on, subscribe. It really helps this channel more than you can imagine. Number 1, build your AI ETF portfolio using the 40-30-20-10 rule. Start with a balanced mix of those large cap, mid-tier innovators, emerging disruptors, and YOLO plays to capture growth while managing risk. 2, follow institutional money for smart positioning. Regularly track the 13F filings, ETF inflows, and unusual volume spikes to see where hedge funds and asset managers are allocating capital. Number 3, implement risk management from day 1. Use position sizing to avoid overexposure. Set trailing stop losses to protect profits, and hedge with defensive assets during high volatility periods. Number 4, monitor AI market periods and adjust accordingly. AI is evolving fast, so set up a routine to review earnings reports, AI adoption rates, and new ETF launches so you can refine your portfolio strategy over time. Number 5, think long-term and avoid the hype cycles. You don't need hype, I don't need hype. We like it, but don't invest in it. The AI sector will have booms and busts. The key is to stay invested in the long-term winners while avoiding short-term hype-driven FOMO trades. AI is reshaping the world, and the biggest financial opportunities will come to those who position themselves early. And we're still early, guys, but wisely. With the right strategy, AI ETFs offer a once-in-a-generation chance to capitalize on this transformation while managing risk like a pro. Now, the real question is, are you going to sit on the sidelines, or are you going to take action? Well, the action you can take right now, smash that like, subscribe, and check out another video right here or here, and I will see you on the next video. Until then, you keep living your life to the fullest. Let me know your thoughts down below on all this. It can seem overwhelming at times, all right? We'll see you. Peace.